All right, now we're going to move away from accounts receivable and start talking about notes receivable. In particular, looking at computing interest, and it talks about recording honored and dishonored notes. I'm not going to go into the dishonored notes or the dishonored notes. Honored notes are the ones that are going to get collected, the ones that the customers are going to use in the normal course of business. Dishonored notes, this is when the note receivable becomes uncollectible. I'm definitely not going to go into that. Now, remember what notes receivable, basically a note is a promise, and it's a written promise that both parties have to sign. And usually with the promise out there, I need to find out how much is owed, when you're going to pay it back, and with how much interest. Now, again, with the principal, that's the amount of money that you owe on the note. The interest is the if I'm the loaner or the maker. If I'm the maker of the note, meaning I'm loaning the money to you, I'm going to be getting some interest on that, and that interest is going to be revenue to me because I loaned you the money. Now, interest is going to be an expense to you because you borrowed the money from me, but we'll talk more about that when we get into the liability chapter. So the interest period out there is the time period that the note is outstanding, okay? And we've got the original date of the note when it's signed to the maturity date that's out there. Now, the interest rate is the percentage of interest that you're going to pay on the note. Maturity date is when it's due, and the maturity value is normally the principal plus the interest that's due at maturity. So the interest value is two things, the principal plus the interest. Okay? So these are important definitions out there when we're looking at note receivable balances and just note receivable transactions. And again, with the promissory note, this is what a typical promissory note could look like. You've got the principal, the date of the note when it starts, the payee who's loaning the money, principal, how much is the note receivable, and then the date down here, that's the maturity date, and then and then the maker of the note, and you also have the interest rate on the note also. So in this case here, if I want to establish a note receivable, what I'm going to do is Smart Touch has loaned money to Lauren Holland for $1,000 for 1 year at an annual rate of 6%. So right now, I'm going to put on Smart Touch is going to put on their books a debit to notes receivable for $1,000 and a credit to cash for $1,000 to record that note receivable. Now, the maturity date on this, sometimes what we're going to be looking at here is we definitely have to register the maturity date and figure out when we need it. Now, in this case here, if it's in months, we can register it by months. If it's in days, we can actually count the number of days. So again, a 180 note dated on February 16th here. We've got 28 days in February. We signed it on the 16th. So we've got 12 days outstanding. And then we can add the month of days and then have a cumulative total. So say on August 15th, this is when that note is going to come due. So on a 180-day note with a original date of February 16th, the maturity date is going to be August 15th. So the formula for calculating interest, and this is going to be very important out there. To figure out interest, it's always principal times interest rate times time. So the amount of interest is always going to be your principal times your rate times time. Now, the one thing I also want to mention to you guys is this. When it comes to time, it's always the number of months divided by 12. It's always expressed as a term of fraction of a year. The denominator in 12 is always 12 if we're looking at months. Now, if it's in days, it's going to be 365 days. Either way is fine. Either way is acceptable. But with the time, it's always measured as a fraction of either months, which would be 12, or days, which would be 365. So you've got to remember that when you're computing out interest on a note. So this example up here, we're going to compute interest revenue for 1 year. So we're going to assume that this note started January 1 and ended December 31st. So the amount of interest, I've got principal of $1,000. My interest rate is 6%, and my time is 12 months divided by 12 months. So really, the amount of interest that I'm going to receive is $60. So that interest is going to be revenue to me. Now, the maturity value of the note as of the maturity date is going to be $1,060, which is my $1,000 principal, plus my $60 interest. And again, the time element here is 12 months divided by 12 because the note is 1 year. Now, what happens if the note is for a fraction of a year? Well, again, no problem here. I can take my principal times my interest rate, and this time it's for 9 months. So my time is going to be 9 divided by 12. And again, drop the 9/12 in the formula, and my amount of interest becomes $150 this time. Or if it's based on the number of days, say on the time frame, $5,000 note at 12% for 60 days. Again, this is going to be $5,000 times 12% times 60 days divided by 365. And again, you've got the amount of interest that you're going to receive as revenue. So in this case here, Smart Touch lent Lauren Holland $1,000 on September 30th for 1 year at an annual rate of 6%. Now, Smart Touch has a year end as of December 31st. Now, I'm going to receive the cash money as of September 30th next year. But the problem is, that person has had my money for 3 months. So from December 30th to December 31st, the person has had my notes receivable. I should be earning revenue, interest revenue on this 3-month period. I'm not going to receive the cash yet. Basically, what I'm going to earn is a promise from that person to get that cash interest as of the maturity date. So in this case here, I've got to record about 3 months of interest to accrue. So I'm going to figure out to be the principal of $1,000 times 6% times 3 months divided by 12. So I should be accruing about $15 of interest. So in this case here, I'm going to debit interest receivable for $15 and credit interest revenue for $15 also. Now, for 2020, Smart Touch earns 9 months worth of interest. So from January 1 through September 30th, there's 9 months worth of interest. So again, I'm going to have $1,000 times 6% times 9 divided by 12. And so for 2020, I've earned $45 in interest revenue. Now, on the maturity date of the note, I'm going to receive cash for that principal amount plus the interest. So what I'm going to have to do is credit my notes receivable for Holland for $1,000. The interest receivable is going to come due in cash now, so I'm going to credit the interest receivable by $15. And then I've got 9 months of interest revenue out there that I should be getting in cash. So in reality, my cash portion should be $1,000 plus, plus basically 6% times 12 months, or $60. So my cash amount that I should get on this note should be $1,060 altogether. So again, you can see with these entries here, in this case here, Rosa Electric sells household appliance of $2,000 to Dorman Builders. Dorman signs a 9-month note at 10%. So here on July 1, Dorman Builders is going to have a note receivable of $2,000, and Rosa is going to record sales revenue of $2,000. Now, from the 6-month period, since Rosa's year end is 12/31, Rosa has to record 6 months worth of interest, but they're not going to receive the cash until the maturity date. So again, that's a promise out there that Dorman will pay the interest when it comes due. So again, I'm going to have a debit to interest revenue and a credit, or a debit to interest receivable and a credit to interest revenue. And again, we're going to compute this to be the principal of $2,000, interest rate of 10%. And this time it's going to be 6 months from July 1 through December 31st divided by 12. So that should be $100. Now in 2020, April 1st, what I'm going to do is credit the notes receivable for Dorman for $2,000, credit the interest receivable of $100, and then credit the interest revenue for the 3-month period, $2,000 times 10% times 3 divided by 12. So my cash that I should receive on something like this should be $2,150 altogether. And again, you could do the same thing with same thing here based on the number of days. Just convert just on the time frame. Just make sure your denominator is 365 when you're looking at the number of days. And again, you could do the same thing if it's days or months. Doesn't matter. It's going to be the same type concept that's out there when we're looking at these notes receivable. So number 15. October 1st, 2019, ABC loaned A. Jenkins $9,000 at an annual rate of 5% with a maturity date of April 1st. So on October 1, ABC Company will report, actually this is going to be a debit to notes receivable for A. Jenkins for $9,000. And that is the case. So we're going to record the note receivable. Now, the maturity date of a 6-month note issued on January 15th would be, well, let's just count the months. February, March, April, May, June, July. This would be July 15th. 16 is A. And that's the case. So for maturity date, when you're looking at maturity date for notes issued on a month basis, just use the old finger approach. It always seems to work for me. Number 17, calculate the interest on a 90-day, 9% note for $50,000 using a 360-day year to compute interest. Again, you can use 360 or 365. Honestly, use whatever the problem's giving you. So in this case here, my principal is $50,000, my interest rate is 9%, and my time is 90 days divided by 360. So that should come out to about, it looks like $11.25. So B is the correct answer on this one. That would be the interest. Moving on. Number 18. On October 1st, Parker Inc. made a loan to one of its customers. The customer signed a 9-month note for $110,000 at 14%. Calculate the maturity value of the note. Well, I know I've got $110,000 out there for the maturity value. It's going to be over $110,000. So C and D are definitely gone. Now, I'm going to have to calculate interest at 14%. So 110,000 times 14% times 9 divided by 12. I'm going to go straight to the answer on this one. Don't mind me. But again, what's going to happen here is my new amount is going to be, my maturity amount is going to be $121,550. So I said the formulas are correct. I just didn't know the answer right off the top. Couldn't figure it out in my head. Lastly, number 19. The following select transactions occurred during 2019 for Northwest Movers. The company ended its accounting year on December 31st. Okay. Let's take a look. I got to prepare journal entries to record these transactions. Now, the first transaction on April 1st, you performed services on account for Ellis Reynolds. This is an accounts receivable. So I'm going to register a debit, an accounts receivable, and credit sales revenue for $12,000. Now, on August 1st, we received a $12,000 3-month 9% note from Ellison in satisfaction of its past due accounts receivable. So really what we're doing here is we're converting that AR into a notes receivable. And yes, this can be done. So anyway, I'm going to debit notes receivable for Ellison and credit accounts receivable for Ellison for $12,000. And then on November 1st, we're going to collect the Ellison note at maturity. So it's a 3-month note. Okay. So for the maturity value, I'm going to credit notes receivable for $10,000 or $12,000. And then I'm going to credit interest revenue for $12,000 times 9% times 3 divided by 12, which is going to come out to $270. So my debit to cash is going to be $12,270. And those are the entries out there to record the notes receivable transactions.